In class, please confirm that you can hear me clearly.
Yes, we can hear you clearly. Good evening, sir.
Okay, that's good. Okay, you're welcome to our class, which is class 2 of financial reporting. Today, we are moving to a very important topic.
Yes, sir.
Hi, Joy, how are you? Yes, so today, we are moving to a very important topic called conceptual framework. Remember, yesterday, we looked at regulatory framework as our topic 1, and in addition to that, we also looked at ethics. Remember clearly, everything that we spoke about under regulatory framework was around regulations that governs reporting. And those regulations, basically, we told you were GAAP, Generally Accepted Accounting Principles, which are rules and principles that governs reporting. And we said there are 3 of them. There are 3 sources of those GAAP. We said we have accounting standard, company law, and local stock exchange listing requirement. We also mentioned that the accounting standard we use in Nigeria is IFRS or IAS. And that IFRS or IAS, I told you that they are principle-based. They are principle-based framework. But the company law and the local stock exchange listing requirements, those are rule-based. So in Nigeria, we use a mixture of rule and principle-based framework. Then I gave you an assignment that you should list the advantages and disadvantages of rule-based framework or rule-based accounting standards and principle-based accounting standards. I hope you had done that today. Then we moved on to the regulatory bodies. And I told you that the regulatory body that governs reporting in Nigeria is the Financial Reporting Council of Nigeria. And this council, they were established by an act in 2011, and this act has been updated or amended in 2020. However, this body, Financial Reporting Council of Nigeria, they have one key objective, and that is to protect the interests of investors and other stakeholders. Though they have other objectives, but that's the key. Then I told you that the Financial Reporting Council of Nigeria are not the ones that developed these standards, that they actually adopted it. That there is a structure behind the IFRS, which we called IFRS Foundation Structure. This IFRS Foundation Structure has a monitoring board as the head of that structure, who appoints the trustees of IFRS Foundation, who afterwards appoint ISB, ISSB, and members of the IFRS Advisory Council. And there is an IFRS Interpretation Committee that works under the ISB. And we explain each of those bodies in detail. But substantially, we learned that the IFRS Foundation has the core objective of developing a single global high-quality accounting standard, and they have delegated the work of developing those standards to the IESB. However, the International Sustainability Standard Board, which is the ISSB, is responsible for developing sustainability disclosure standards. We also learned about how we set or develop IFRS. And we moved to ethics, where I made you understand that you as accountant, there are some fundamental principles you must uphold. And I informed you about the threats that can hinder you from complying with those fundamental principles. And if you are faced with those scenarios, how do you safeguard against them? Those were what we discussed last week, and we looked at some past questions as well. Today, we are going to be looking at conceptual framework. Now, you see, conceptual framework basically are the principles. Conceptual framework are principles that underpins the development of IFRS. Remember, I told you that IFRS is principle-based. So when you say something is principle-based, it means that it only gives you guide. It only gives you general direction, foundation for reasoning. You see, the principles that underpins those IFRS, those general guide, that is the conceptual framework. So today, which is why I said this is a very important topic, which is why I said that the conceptual framework, being the principles, are what they use in developing all IFRS. And for my next class, I will start teaching you standards, and that will go on for several weeks. You will see that every IFRS has a similar structure. They have a similar arrangement. You see that every IFRS, there will be definition of terms, there will be recognition criteria, there will be measurement basis, there will be presentation, there will be disclosures. All standards follow that format, except some few ones that are dealing with general issues rather than specific items. You see those ones, those standards that deal with specific items, they have similar structure. And the reason is because all IFRS are developed from a source, a singular source. And that singular source is the conceptual framework. So the conceptual framework are the set of principles that underpins the development of IFRS. Now, how does this help? Having some set of principles that we have sat down, we know that these are the principles that we use to develop IFRS. How does that really help? Does it have advantage? Can we come up with some advantages of having some set of principles where we develop all IFRS? Because they could ask you in the exam that what are the advantages of having a conceptual framework? Some of the advantages are: one, when you have something like a conceptual framework, it means that it will make the development of IFRS to be coherent and standardized, which means that whenever we want to develop an IFRS, we won't just develop it based on the issue at hand. We already have how we develop standards. We already have the principles we know we are going to rely on. So there will be coherence and there will be standardization. We will not just be doing it anyhow as the spirit directs. We won't be doing that. Also, with this conceptual framework, users will see that, will verify, users will verify that accounting regulations are from a single source. They will see that we are very structured and organized, right? They will understand that accounting regulations is very structured. So users can verify that with having a conceptual framework. Another one is that because we have a conceptual framework where all the principles are, that means that if we have issues where there is a transaction that no one has seen before, or a transaction that an IFRS does not cover, how do we then treat such transaction? That means the conceptual framework will be able to help. So anytime there is, since that is where they develop IFRS from. So whenever we have a transaction that we don't know how to treat, or what I call unusual transaction. So the conceptual framework can help in the treatment of unusual transactions. And finally, could be that with this conceptual framework, it will ensure that similar transactions are treated in a similar way. Now, what are the disadvantages of this? I mean, I can't see any disadvantage here because, I mean, there's nothing better than having a single source of truth that whenever we have a new standard to develop, this is where we go to. The only thing we could just think about as the disadvantage of this conceptual framework could be that I mean, maybe it might not make the work of developing standard any easier, the work of developing standards or IFRS any easier. Maybe, I mean, we just have to come up with a disadvantage because from these advantages, what I'm saying that because since we have a set of principles that we use to develop IFRS, then one would think that that would make it easy to develop IFRS. No, you remember I taught you the steps in developing IFRS. Those steps are still there. They will still have to come up with work plans. They will still have to come up with discussion papers. So it does not make the efforts, okay, of developing standards any easier. And another one is that a single framework or a single source of truth, okay, might not be sufficient to address the accounting issues of variety of users. Remember, IFRS is used by almost every country in the world. Now we are saying, okay, we have come up with some set of principles that this is where we will develop IFRS from, which we call conceptual framework. So, I mean, that could be a disadvantage in the sense that a single set of principles, a single framework might not be sufficient. There might be some gaps. So, which means the conceptual framework itself might need continuous updates. Anytime they see a gap, they will update. And that is what has been happening. In 1989 was the first time they introduced conceptual framework. They updated it in 2010. The one I'm going to teach you today is that of 2018. So as new things are coming, they will have to be updating it. So those are kind of disadvantages. Now, another thing I've seen them ask you around this area is the purpose of a conceptual framework. You see, that's different from the advantages. Purpose, what's the use? I mean, and we can easily think of the usage. You know, based on how I've explained it, I said there are set of principles that underpins the development of IFRS, which means that whenever they want to develop IFRS, they use the conceptual framework. Therefore, the first purpose of the conceptual framework would be to the IASB. So the IASB use the conceptual framework. Permit me to do CF as conceptual framework. Use the conceptual framework to develop new accounting standards, and amend existing standards. Okay, that's the major or primary use. Another use will also be the IASB. So the IASB, you also can use this conceptual framework to converge and harmonize international regulations, which means that I explained this to you yesterday. Whenever the ISB wants a country to adopt IFRS and the country says no, I told you that the next line of action for them is to work towards convergence, like they are doing with the US. So the US, what they are doing with them is strange because they are amending their standards to suit them. But for most other countries that are not world power like the US, what they would do is they will advise and recommend those countries to use their conceptual framework to develop their own standards. So ISB use it to convince countries that, okay, use these principles to develop your IFRS, to develop your local standard. They know that when they use it, that means their standard will ultimately be similar to that of IFRS. So ISB used the conceptual framework to converge and harmonize international regulation. It's also used by this conceptual framework can also be used by anybody, by companies, which I will call the preparers of financial statements, which are companies. So the preparers use the conceptual framework to apply, okay, to apply the standards, when they are preparing their financial statements. It can also be used by other users like investors, okay, like creditors. So those users can use the conceptual framework to apply, to interpret and understand financial statements. The conceptual framework can help them to interpret, because if you understand the conceptual framework, you can easily understand financial statements. Also, another people that can use this conceptual framework is the national accounting standard setters, the national standard setters. If, for example, FRCN, if we were developing our standard locally, then they can use conceptual framework to develop their standard. So the national standard setters can also use the conceptual framework to develop local standards. Yes, they can use it to develop their local standards. Also, the IFRS Interpretation Committee is the conceptual framework they use. The IFRS Interpretation Committee also use the conceptual framework to develop interpretations on IFRS. Okay, well, so the auditors can even use it too. The auditors also use the conceptual framework to form an opinion on the financial statements. Well, again, yeah, there's something I will teach you around accounting policies much later into the diet. you see that every item in the financial statement, every figure you find in financial statement, there is a backing accounting policy, right? And you would also learn that accounting policies are developed by IFRS. They are developed from IFRS. So when we have a situation where we want to develop an accounting policy, and in those situations, we don't have a backing IFRS, and we need to develop accounting policy. Of course, the conceptual framework can help. So it can also help the preparers to develop consistent accounting policies where there is no standards. Okay, so that's the first part of this conceptual framework, talking about what it is, the advantages, as well as the use of this conceptual framework. Now, let's now go into what are these principles themselves that I've been talking about since. So, you see, the 2018 conceptual framework was structured into chapters. There are 8 chapters. So I'll call it content of the conceptual framework. There are 8 chapters there. And the chapter 1 talks about objective of general purpose financial reports. The chapter 2 talks about qualitative characteristics of a useful financial report. Chapter 3 talks about the financial statements and the reporting entity. The chapter 4 talks about elements of financial statements. Chapter 5 talks about recognition and the recognition of those elements of financial statements. Chapter 6 talks about measurement of those elements. Chapter 7 then talks about presentation and disclosure. Then the last chapter, which is chapter 8, that talks about concept of capital and capital maintenance. Okay, so this is basically the content of the conceptual framework. You have to know this as a financial reporting student. This is the very first thing you need to understand very well here before you jump into learning the IFRS. So let's pick them carefully, one after the other, starting with the chapter 1 that talks about the objective of a general purpose financial report. So let's go straight to the point. The first thing here is this: what's the objective of a general purpose financial report? So the objective of a general purpose financial report is to provide financial information about a reporting entity that is useful to potential and existing investors lenders, and other creditors to enable them make decision about providing resources to the entity. So, I mean, your exam requires that you should be able to tell us the objective of a general purpose financial report. So now, look at it. It said the objective of a general purpose financial report is to provide financial information. That's the key thing here. Let me bold that. To provide financial information about a reporting entity, that is useful to potential and existing investors, lenders, and other creditors. That's another keyword there. To enable them make decision about providing resources to the entity. Make decision. Okay, so those are the key things here. Now, let's break them down. The first one is this. It says the objective of a general purpose financial report. First, I'm sure you understand that financial reports is basically like a financial statement, like an annual report, and is usually general purpose because it's meant for a lot of users, right? So general purpose financial report. So we are saying what's the objective? It's like saying what's the objective of learning this financial reporting that we are learning in this class. Okay, so now we are saying here that it is to provide financial information. Okay, so the key question we should ask is to provide financial information. What are these financial information? That's the first thing here. What are these financial information? I'm sure some of you might be tempted to tell me that this financial information is the statement of profit or loss, statement of financial position, statement of cash flows. That would be very wrong. That would be very wrong. They have asked it before. I will show you. The financial information here that we are providing is not those statements, but rather there are three financial information we provide in an annual report. The first financial information we provide is information about the economic resources of an entity, which is synonymous to the asset of that entity. We're telling them that this is our assets. Number two is claims against those resources, which is speaking about the liabilities of the organization. And three is changes in the economic resources and claims, which is talking about income and expenses. Everything in a financial statement is this. Though those statements of profit or loss, that is where you find that's where you find information about income and expenses. The statement of financial position, that is where you find information about assets and liabilities, like that. So those statements are not the information. When the examiner asks you, they have asked it before. They asked according to the conceptual framework. In fact, they gave you guys this definition. They didn't ask you to regurgitate it. They gave you. Then I'll say, okay, kindly tell us, according to the conceptual framework, the financial information that is provided to users. If you write anything beyond this, you're wrong. Even if it is just assets, liabilities, income, and expenses that you remember, you will get your full marks. I mean, you're in this class. Why shouldn't you tell them the way it is? Economic resources of an entity, which is their asset. Claims against those resources, liability, changes in economic resources, and claims. So those are which are income and expenses. These are the financial information. So the objective of a financial report is to provide those financial information about a reporting entity. So, I mean, this is the company, and I will talk more about this when I get to chapter 3. So let me just, chapter 3 talks about reporting entities. So let me just leave that for now. And I'll say that this information must be useful to potential and existing. That is very huge. It's a potential and existing. So it should be useful to even those that are not already any of these three people we want to mention. Potential and existing. They now mentioned investors, lenders, and other creditors. Therefore, if they ask you in the exam that according to the conceptual framework, or generally in a financial reporting question, that who are the users of financial report? Please, these are the users according to us. These are the three people. Any other person you must have learned in maybe PSCF or in PM, FM, like that. We do not see them as a user here. We are providing this information to three people: potential and existing investors. Everybody here knows who an investor is. Investor is the provider of risk capital. Investor is the guy that gives you money to run your business. Without an investor, you don't have a business. That's the reality. So he is very important. The second person is the lender, the banks, your creditors, those that lend you money, which is, of course, and also other creditors. These are people that sold goods to you on credit, your suppliers. These guys, they are like the blood of the business. Without them, you won't have a business. So, as far as this conceptual framework is concerned, as far as accountant is concerned, whenever we are preparing financial report, those information inside those reports are meant for these three people. So usually we can say the primary users of financial information are investors, lenders, other creditors. I mean, from that definition, I can bring that up. You now said to enable them make decision about providing resources to the entity. Then somebody can ask you, what decision? What decision? I mean, it's easy. The investors, they want to make decision whether they should sell or buy the entity's shares. That's what the investor do. Or the investor also votes. How to vote? How to vote during AGM. Or, I mean, that's basically what investors do. Whether they should vote against or for the management, the existing management, whether they should sell or whether they should buy more shares. Also, lenders would look at whether they should lend more money, lend more funds to the entity, or take steps towards recovery of existing debts. I mean, if they see that the company is not doing well, then they will start taking steps on how they want to recover their loans. Those are the decisions these guys wants to make, right? And the creditors would make decision on whether they should provide additional credits, or let me call it trade credits, additional trade credits to the entity. Those are the decisions these guys wants to make. Now, lest I forget, I need to mention it here. You see, this financial information that we provide to users, okay, you need to know something we call accrual basis of accounting. This information, the way we prepare it is based on accrual basis. That was what the conceptual framework says. And a the opposite of accrual basis, or another basis, let me not call it the opposite, another basis of preparing financial information is cash basis. Okay? So if you are not using cash basis, then you have to be using accrual basis. And when you're using cash basis, your financial information will only reflect money paid and money received. That is all your information would reflect. But when you're using accrual basis, what you are recognizing is not just money, but what you will be recognizing are economic activities, not money, economic activities. Whenever you buy something, whether you pay or not, you record it. Whenever you sell, whether you pay or not, you record it. So whenever you incur a cost, okay, whether you have paid or not, you record it. Whenever you earn an income, whether you have received money or not, you record it. That is accrual basis. Record all our economic activities, not cash flow. All our economic activities. Of course, cash flow inclusive, right? So whether they have paid or not, we record it. Okay, that's accrual basis of accounting. It looks at the entire business ecosystem, your entire transactions, and it reflects it in the books as financial information. Okay, and that is what chapter 1 of this conceptual framework is actually talking about. And it reflects how standards are developed in terms of the focus of who the users are, in terms of which information we are providing, in terms of how should those information be provided. And it is from here you see that all IFRS they are focused on accrual basis. They are never targeted towards cash recognition. They are more focused on economic substance, economic activities. Okay, so let's not overflog the chapter 1. Let's move straight to chapter 2. But before I move to chapter 2, do we have any questions? You know that you don't have to be quiet in class. You can ask questions. You can ask questions. And I mean, you can see that the whole of this week, even though you will be seeing calculation, but financial reporting is about principles. Even though we will do some workings, but you need to understand all of these theoretical bases. Like those of you that missed our class yesterday, the video is already on YouTube. Go and digest it immediately. Today's class is one of the most, if not easy, for me, is the most important class. If you don't understand today's class, the others you will not understand them deep down. You will just be understanding surface. Surface. Like I've mentioned a very important thing now, accrual basis. Everything I'll be teaching you is accrual basis. I've mentioned financial information. I mean, a lot of you would think the financial information we provide are those statements. No, those statements are not the financial information. They are just a container of those information itself. The information are asset, liabilities, income, and expenses. And look at the users of financial statement. For us, is these three people. These are key things you need to make sure you note. Now, qualitative characteristics of a financial report. So we are saying that What are the attributes a financial report should have, should possess before it can, pass as a financial report? They are categorized into two. There's the fundamental characteristics, and there is the enhancing characteristics. The fundamental characteristics, these are the attributes. The fundamental characteristics are the attributes that makes the financial reports useful or not useful. That's powerful. I said the fundamental characteristics are those that make the financial report useful or not useful, in the sense that a report that does not have these fundamental characteristics is not useful. It's not useful. And when it's not useful, that means it doesn't meet the objective, because the objective is to provide information that is useful to potential and existing investors and all of these guys. So if it's not useful, it's over. But it means that every report must have these fundamental characteristics. And what are they? Number one is relevance. Number two is faithful representation. These are the two fundamental characteristics: relevance and faithful representation. Now, what do they mean? Relevance means the way it is in English word, when something is relevant to you. So the conceptual framework says that when we say relevant, it means that the financial information of the financial report must be capable of making a difference in the decision that is made by users. So the key word here is capable of making a difference. So relevance means that the financial report must be capable of making a difference in the decision that is made by a user, which means that when you want to decide on whether you want to invest or not to invest in a company, when you pick up their financial reports, it should be able to inform your decision. It should be able to make a difference in your decision, whether to support your claim to invest or to contradict it and say do not invest. That is relevant. Okay, that's the characteristics of relevance. And when we say something is capable of making a difference, in the conceptual framework says that it means that it must have predictive value. It must help you to decide. When I say having a predictive value, we are not saying that the information will give you forecasts or information about the future. No, it must just have predictive value. When you should be able to use it to predict. And the second one is confirmatory value, meaning whatever predictions you have made, it should confirm. You should be able to confirm that prediction with the financial report in the future. And to make this clearer, I will give you examples of items we are going to learn later in the future that makes the financial information have predictive value. Example, the very first one I would tell you is disclosure of discontinuing operations. discontinuing operations in the financial reports. You see, there's a standard called IFRS 5, which I will teach you. That standard says that whenever an entity plans to discontinue or shut down a segment of that company in the future, not now, it says you have to disclose it. You have to tell the user today that we are planning to shut down a segment though. It's not you just shut down. No. There's a standard that says that you must tell us if you plan, anytime you have a plan, whether that plan is going to be executed in 5 years' time, you need to tell us immediately. You need to disclose that discontinuing operations separately from continuing operations. It's just like when GSK left Nigeria. I mean, when I looked further into their case, I saw that since 2017, they have been presenting discontinuing operations. That this segment, this Nigerian segment, we will shut it down. It's there. So accountants have seen it. They know. Those that want to exit have started exiting. So it really helped people to make predictions because they know that this company is leaving from their financial report. That's what we mean by predictive value. It will make a difference in your decision. Another one is when you present material items separately. Present material items separately in your financial report. It's just like when an entity makes a gain on disposal of an asset. You make a lot of gains on selling an asset. IS1 and IFRS IS 16, IS1 now, IFRS 18 though, you would say that you need to present this separately because it's a one-off item. Sometimes they will call it an exceptional item. It's a one-off. It's not something that will reoccur later in the future. Present it separately so that user will know that this spike we have in our profit this year, it might not reoccur next year. It's just because we have a one-off gain, an exceptional gain for this year. That is making it have predictive value. I mean, later when I'm teaching you IS 33, you will learn about diluted earnings per share. So disclosure of diluted EPS in the financial report also gives it predictive value because when we say diluted EPS, we are saying that we have some ordinary shares that are potential. We have some potential ordinary shares. They are not ordinary shares yet, too, but they would become ordinary shares. And when they become ordinary shares, this will be the position of your earnings. This is how far your earnings will reduce. That's what diluted EPS shows. It shows you that when all potential ordinary shares becomes a part owner of the company, becomes ordinary shares, this is the reduction that will happen. This is where your EPS will now be. This is where it will fall to. That is a diluted EPS. So anyone that wants to exit and run, you can see, it's like making you see the future, something like that. We can go on and on. As we continue to learn principles, standards, you'll be seeing that the standard, when they were developing it, they had this relevance in mind, giving every standard a drop of having predictive value. I mean, I would not at your level, but there is something we call impairment of financial assets. That whenever we see that a receivable has some financial difficulty or is facing some difficulty in his business, we won't wait until the guy defaults. Immediately, we are going to make provision or allowance for receivables, but now we call it impairment of that financial asset or receivable. That's allowing user to make prediction. when you're disclosing or presenting those kind of figures in your books. Okay, we need to move forward so that we will not spend the whole day. I can continue to list on and on all items that makes the financial report have predictive value. Confirmatory value is just the way it is. I mean, it's just okay, present it the way it is. Then we should be able to see that, okay, they have discontinued. Then, I mean, okay, in the future, we saw that, okay, that profit they made last year, this year they didn't make it. It should be able to confirm it. They should continually update their report to show that. Okay, so that's what we mean by relevance, capable of making a difference, which means it must have predictive value and confirmatory value. And lest I forget, you see, there's something we call materiality. Is under predictive, is under relevance. Is under relevance. So there's no way I can talk about relevance without talking about materiality. Materiality is very important in reporting. In fact, when auditors come, the first thing external auditor do is to set a materiality threshold. They will do their performance materiality and the other one as well. And that's what will guide all their audit procedures and sampling. So the same thing here also. When an entity knows that an item is material, they should present it properly. They should recognize it properly. It should be presented the way it should, because a material item is an item that when you omit it or when you misstate it, it can affect the decision users would make on that item. So for that reason, it can seriously impact relevance. So materiality can impact relevance. That if you omit an item that is relevant or that is material, I mean, it can make your whole report to be not useful, to be irrelevant. So materiality is important when we are talking about relevance. Okay, so that's it for relevance. Now, the second fundamental characteristics is faithful representation. And when we say faithful representation, what this means is that the financial information must present the phenomena it purports to represent. So, faithful representation simply means that when you are presenting your revenue, for example, and you present 100,000, you see, that's 100,000 you are presenting, it must represent the phenomena. If I let me call it economic phenomena, meaning your economic activities. Meaning, tell us the truth, don't lie. Because financial report is basically an economic phenomena in words and numbers. When I say economic phenomena, it's just showing your economic activities, your revenue, how you have spent your money, the asset you have bought, the liability you have. Faithfully represent them. What you're presenting must represent that economic phenomena. Now, to do that, there are three things involved. Number one, make sure that the information you are presenting is complete. Make sure that the information you are presenting is complete. Don't understate your revenue or omit any item. You have to present the entire picture. Tell us everything. If there's an item that you cannot present to us in number, present it in word. Explain it. Explain it. If you change CEO, explain it in your financial statement. If there is a critical change in your organizational structure, explain it to us. We want to know everything about what is happening to your company. It's not just about numbers. It has to be complete. Tell us about anything that will affect your economic progress as an entity. Complete. Number two, it must be neutral. You see, reports cannot be presented in a way that will be biased. No, it should not be biased. That's what neutral means. It should not be biased. You cannot have a mindset that this year is 30 million revenue will present. No. You cannot say because analysts have said, this company is going to make $1 billion this year. You are now presenting that. No. You have to be neutral. Present your economic activities the way they are. And being neutral is, I don't know if any of you have heard of prudence before. That's why they said accountants are prudent people. I mean, they would mean prudent to mean that we don't spend money. No, that's not what prudence means. Prudence here means that we should not overstate, should not overstate your income and assets, nor understate expenses and liabilities for whatever reason. That's prudency. And which is why when we are presenting the carrying amount of an asset, we usually present it as costs less accumulated depreciation, showing the portion of the asset that we have used. Or when we want to present our trade receivables, we will present it less any portion that we cannot collect anymore. That's being prudent. We are not over ambitious. And that is why when the value of your asset goes up as a result of economic environment, as a result of inflation, you would not quickly go and present that in your P&L as a gain. We don't. We would rather go and put it as a reserve in OCI because it's not a gain that we can share, except if that gain is coming from foreign currency. If it's a foreign currency gain, because that one is cash. If you have dollars now in your DOM account and the exchange rate was 1.5 and the exchange moves in your favor is now 1.6 to $1, that gain you have made, you can put that one in P&L because it's cash, it's liquid, it's money you have already. I will teach you that when I'm teaching you IAS 21. So that's prudency, right? Everything about all the standards I'm talking about ensure that we present our numbers prudently. Okay. And the third one is free from errors. Please note that when I say free from error, I do not mean that the financial information, the numbers, the words, that they are accurate. No, they are not accurate. In fact, in reporting, we make use of a lot of estimate and judgment. Remember, it's principle based that we use. We make use of a lot of estimate and judgment. For that reasons, our figures are not accurate. But when we say free from error, what we are saying is that the description of the economic phenomena must be free from error. Don't describe the wrong thing to us when you're describing what has happened. Describe it the right way. Describe it correctly. You're not talking about our figures. We're talking about description of our transactions, economic activities, and all. Also, the process of determining the figures or the numbers should be free from error. That's what we want to be free from error, the process of determining that figure. Make sure it is free from error. And that process is your double entry, for example. Don't go and credit an item you should debit. That is an error. Okay, that's a major one. Or an item you should classify as expense. You now go and capitalize it as an asset. We don't want that. Those are major errors that we are talking about. And when we say free from errors, that is what we mean by that. So faithful representation is powerful, is this three. And all accounting standards that we are going to learn reflect these three. They ensure that when you're reporting any item, it's complete. They ensure you report everything around that item. They ensure that we find a way to ensure that you are neutral. We have put restrictions on how you measure your items to ensure that it's prudent. That's because prudency is neutrality. And also, the description of the economic phenomena and the process of determining those phenomena must be free from error. And that's why every standard has a guide for disclosures. They are guiding you just so that you will not be describing wrongly those items. That's why they give us, every standard has a disclosure requirement just to ensure it is free from error. Now, there are two things that I have to talk about. As far as, yes, these three represents faithful representation. But even amidst these three that I've mentioned, two things can affect your faithful representation. Number one is something we call measurement uncertainty. Number two is substance over form. These are two powerful terminology. Let me start with measurement uncertainty. You see, I would still explain measurement in further detail very soon. But for now, measurement is how we determine our figures in the financial statement. And I've explained earlier that in determining our figures in the financial statement, we make use of estimate and judgment. We use models to determine our figure. Okay? That process with which we determine those figures makes it uncertain. That's what we call measurement uncertainty. Because the process of determining most of our figures is using estimate and judgment. Okay, so there is a level of measurement uncertainty. So the key word here is this. It's just a word of caution that the level of that measurement uncertainty must be reasonable. It must not be too high. When the level of measurement uncertainty is too high, that means your reports might not be free from error. It might not be complete. So we want you to know that when you are making estimates and judgments, ensure that those estimates and judgments are within a reasonable defined basis. You must have a basis for your estimate and judgment. Don't just make estimates. They said it's principle based. Yes. I will just estimate. No, your estimate have to make sense. It's just like when you're estimating the useful life of an asset. For example, now you bought an iron die. You now said, the estimated useful life of this iron die is going to be 50 years. No, now, what's the basis for that? Is it that you bought one before that used 50 years? Or you saw another company that bought it and used 50 years? You have to explain the basis of your measurement. Otherwise, we are going to regard it as having high level of measurement uncertainty and will not, that means your report is not useful. So, in fact, IS1, which is now IFRS 18, requires that all areas of measurement uncertainty must be disclosed. So, all the areas, you see, all the areas where we made estimates, they will disclose everything. It's always in an annual report, just so that user will understand and they will explain the basis of those estimates. This is ensuring that the level of estimate uncertainty or measurement uncertainty is as low as possible. Okay, again, so measurement uncertainty is the fact that we use estimate and judgment to determine our figures. That is what measurement uncertainty means. But we are saying that the level of that measurement uncertainty can affect faithful representation. If you don't explain your basis for making your estimate, it means that the level of measurement uncertainty is too high. It's too high, and it might not be free from error. I hope that is gotten. The second one is substance over form. In fact, we can write this fully as economic substance over legal form. Two words here, or two phrases. One is economic substance. The second one is legal form. But they commonly shorten it as substance over form. So this means that when we are presenting our financial information, when we are presenting our transactions, we present the economic substance of those transactions and not their legal form. That's why they call it economic substance over legal form. So when we say economic substance, it means the financial and economic reality. It means financial and economic reality of a scenario or a transaction. I'll give you two examples. Number one is leases. You leased an asset. You see, the legal form of that transaction of lease or renting an asset, the legal form is that the owner of the asset is the landlord, while you are just a tenant that just borrow the asset. You don't own the asset. But that's the legal form. That's the legality. But the economic reality, what is happening as far as that asset is concerned, is that that asset is used by the tenant, and that tenant might be using that asset. In fact, will be using that asset to make money, especially if it's a plant or something that is using like a factory. Is using it to make money. That is the economic reality. That is the financial reality of that transaction. And for us accountants, anything that makes money for us is an asset. Anything that makes money for a company is an asset. So you find out that there is a standard called IFRS 16 thing that will say, even though that asset is not your own, but this asset is making money for you, for that reason, put it in your books. So we'll find out that we'll be putting a leased asset in our books because that's the economic reality, because that's the financial reality. You're making money from it. You're making money from it. That's the reality. Or another example, you sold an asset. You sold an asset to a third party, but that asset that you said you sold, you collected money for that asset. But that same asset, you are still using it. It's still within your premises. You're still using it. And you say you sold it. You collected money. You see, the legal form of that transaction is that you have sold this asset. Fine, you sold it. It's not your own anymore. But what we can see, the economic reality is that you are still using this asset. You are still using this asset. So for that reason, we will say continue to recognize this asset in your books and you have not sold it. Don't recognize sales on this asset because that's the economic and financial reality. Another example is you sold an asset. You now told the person or the buyer that you're going to buy this asset back at a fixed price. You told the person that you're going to buy it back at a fixed price, at a price different from fair value. You sold it, but you can buy it back at a fixed price. I will teach you later that you did not sell. You did not sell because for the fact that you can buy it at a fixed price, it means that you have not actually sold. In reality, you haven't sold this asset. You just told the person to hold it for you. And that money that you collected, probably you need money at that point in time to sort some things. You just like saying, yeah, use this asset as collateral, give me some money. When I pay you back, I will collect my assets. That's what it means, really. That's the economic reality. That's the financial reality. Okay, let me not overflog this. You have a lot to learn. This is the conceptual framework. Is wide. You can continue to explain it for 3, 4 classes. I will not finish because it's huge. Everything you are going to be learning in IFRS, I will always still be coming back to this set of principles. That is substance over form. And the examiner can ask you what is substance over form. Be able to explain it with those examples I've given you. You will see them in your notes. Be able to explain it with those examples. It will go a long way to earn you a lot of marks. Okay, that is it for fundamental characteristics. That's it for fundamental characteristics. Any questions? Okay. Can see that you guys in this class are genius and geniuses. You don't ask questions. I want to believe it's because you understand everything, not because you are not listening, or probably you're distracted, or probably you are sleeping.
We are active.
Look, what did you say?
I said we are active.
Oh.
We're here.
Yeah, Ashiri, nice one.
Yes, sir, please, I want to confirm something. Please, I don't know, you don't help us to drop this workbook for yesterday's class.
Oh, Semiat, sorry, I thought you didn't need it again.
We did, please. And today's Zoom.
Okay.
Thank you.
Okay. Now let's move to enhancing characteristics. So this will not take us time because this is not as important as the fundamental because this one, while the fundamental makes the information useful or not useful, this one only makes it more useful or less useful.
Excuse me,
That's what this does.
sorry, Mr. Matthew, can I ask a question before you proceed?
Yes, please ask me
Okay.
questions.
Yes. So, if you bring your slide down a bit. Yes. So here, when you were talking about relevance and faithful representation, if you notice up when you talk about uh, faithful, yes, I think yeah, there was a place where you talked about is it materiality and though you numbered it then, I think materiality and sorry.
Okay. So what exactly do you need?
Yeah, so sometimes it's a little confusing. Are they the same? Is it one a subset of the other, or they are just independent of each other? I think it is here really, because I can't
Yes.
really see. Exactly, yeah,
Yeah.
see materiality. You talk about materiality, then you talk
Yes.
about faithful representation.
Ye-
So up there, you see what you wrote them before. Fundamental characteristics, useful, you see relevance and faithful representation. So you talk about relevance, right? And so
Yeah.
relevance, when you talk about relevance, so are they all part, so you say relevance and you say materiality, then you're not talking about faithful representation under here. So it's just sometimes a little confusing for me if um, how all of them come together. How can I just piece them together to at least get a better understanding of um, how they relate, if you understand what I mean.
Yes, I do. So the qualitative characteristics first, there are two of them, fundamental and enhancing. Then I started with the fundamental, which are two, relevance and faithful representation, two fundamental. Then I picked relevance first, which I explained. And I said that materiality is under relevance because you need to identify items that are material and ensure you present them properly. Otherwise, your report will be irrelevant. And that's where I ended explanation on relevance. Then I went to the second fundamental characteristics, which is faithful representation, which I explained first with these three, complete, neutral, and free from errors. This is faithful representation. And I also said that additionally, there are two things that can also affect faithful representation: measurement uncertainty and substance over form. They are both under faithful representation. So measurement uncertainty is the fact that we make use of estimate and judgments. And this estimate and judgment needs to be explained and tell us the basis. Otherwise, the level of measurement uncertainty is deemed to be very high, which is going to affect your faithful representation because those figures might not be free from error. Then I explain substance over form, which is also very key because information must reflect economic and financial reality, which is the economic substance and not the legal form, right? So if you don't present your information based on their economic substance and legal form, it cannot be a faithful representation. So all these are under faithful representation. So did I answer your question, Udolu?
Yes, perfect. Thank you. Thank you.
Okay, good. All right, so let's move to enhancing characteristics. Like I mentioned earlier, this makes the information either more useful or less useful. And there are three of them. There are three enhancing characteristics. Number one is comparability. I said three, four. Number two is timeliness. Number three is understandability. And number four is verifiability. So these are the three enhancing characteristics. This makes it more or less useful. Okay, if your report has these four characteristics, good for you, it makes it more useful. If he does not have it, it doesn't mean it's not useful, but it's less useful. So this one is very straightforward. Your report must be presented in a way that it's comparable. It's comparable. And that's why you would usually present a 2 years report, just so that we can compare one year to the other. And we should even be able to compare your financial report to another entity within the same industry. So it should be comparable. That's why issues around that is where issues around consistency of presentation will come up. So the way you present item this year should be the same way you present it next year in terms of description or classification of that item on the face of the account. So because it makes it comparable. The next one is timeliness. Your report must be presented to investors, lenders, and creditors when they need it. It must be presented to regulators at all the regulatory deadlines. Things has to be done as okay. It doesn't mean that because you want to meet up with a deadline, you should now omit key details in your financial reports. That one makes it incomplete. That makes it lacks faithful representation. So even though we are saying you should be timely, ensure that the fundamental characteristics are intact. But timeliness means that provide the report as at when it is needed by the users. Now, for understandability, this means that the report must be easy, must be concise. It should not be unnecessarily complex. I mean, when professionals picks it up, they should be able to relate with it. That's what makes it understandability. That's what makes it understandable. Professionals. So, and we are not saying it should be understandable to everybody because it's not everybody that have reasonable knowledge of business and accounting. And that's how this conceptual framework defined a user. He said a user is somebody with reasonable business and accounting knowledge. And in fact, must be willing to study the financial report. So if you have reasonable business and accounting knowledge and you're not willing to study it, I mean, we don't see you as a user. So it must be understandable to those type of users. They should be able to relate with it. And finally is verifiability, meaning that we should be able to recheck. When we say verify, we should be able to recheck. We should be able to recalculate your figures. Meaning you should have given us breakdowns by in such a way that when professionals will calculate it, you should be able to get something similar. It might not be exactly what you have gotten, but at least something similar to what you have. Something very similar to what you have. That is what we mean by verifiability. That's verifiability. And these are the enhancing characteristics. And that is it for chapter 2. However, you see, meeting these characteristics requires a lot. So the conceptual framework calls something cost constraints. And this cost constraint is talking about ensuring that the cost of meeting up these characteristics outweighs or the benefit your of providing this information outweighs the cost of preparing this information. I hope you understand what I mean. The benefit of preparing these reports must outweigh the cost of getting the reports ready. That's cost constraint. So if you're a small organization, manage your costs, manage your expectation. Don't say you want to make faithful representation and the rest. You're not incurring unreasonable costs to prepare financial report. So that's the end of chapter 2. Okay, go ahead. I can see your hand. Go ahead with your
So,
question.
okay, sir. So when you were talking about variability, you said if professionals want to recalculate, they should have, if not exact, something similar. I want to know why not exact.
Because in preparing reports, we make use of estimates and judgments, and our figures are never accurate. So we don't expect that when we are doing our own computation, the estimates we might use might be different from the estimates you're using. For that reason, there might be some differences in final figures, but it should not be far apart because of that estimation.
All right, thank you.
You're welcome. Any other questions, please? Any further questions? Okay. Chapter 3, this talks about financial statements and the reporting entity. Okay, so financial statement is similar to financial information. It will provide information about income, assets, liabilities, expenses, like that. That's what a financial statement is. So I won't repeat that anymore, similar to what financial information is. But the first thing here in chapter 3, it talks about a reporting entity. And it says that a reporting entity is an entity that chooses to prepare financial reports, okay, or an entity that is required to prepare financial reports. And it must not necessarily be a legal entity, meaning even a sole proprietorship or partnership business can be a reporting entity. It must not be a legal entity as it were. Okay, so that's a reporting entity. Chapter 3 also talk about reporting period, which is usually the period covered by the financial reports, and usually would be a period of 1 year, which we regard as the current year. And usually a reporting period can also cover previous period. Okay, this is coming up to ensure comparability. So we see reporting period as both the current period, the current year, and the previous period. Now, when we are talking about chapter 3 also talks about consolidated and unconsolidated reports. An unconsolidated report. And you will learn about group accounts. Is where an entity has subsidiaries that they will find themselves having to prepare consolidated reports. And you will learn that it's better to prepare consolidated report because it gives us more information about the reporting entity. It gives us more information about your organization. Okay, and that's what consolidated and unconsolidated is talking about. And also, chapter 3 talks about perspective to the financial statements. So this is saying that when you are preparing your financial statements, it should be based on the perspective of the entity, not the investors. It should be based on the perspective of the entity. So what we are saying there is this: your financial statements must reflect your economic activity, must reflect the company itself, not the expectations of investor. I mean, this is just emphasizing the issue of neutrality. Is emphasizing the issue of bias, that you cannot be biased, right? And finally, chapter 3 talks about going concern. That financial statements are prepared on the assumption that the entity will continue to operate into the foreseeable future. And that is what chapter 3 of the conceptual framework talks about. And that's the end of chapter 3. So all these ones are not much, and I've not seen I can ask questions in this area before. Okay, so let's move to chapter 4. Chapter 4 of the conceptual framework. And chapter 4 talks about elements of financial statements. So according to conceptual framework, there are 5 elements of financial statements. We have assets, we have liabilities, we have equity, we have income, and we have expense. So these are the elements of financial statements. So what are these items? Because I mean, these are everything you'll be learning in this class. These elements, we call them elements. And if you remember, that's what chapter 1 called economic financial information. These are the financial information, really. So here we are saying their name is actually elements. The first one, which is an asset. Everybody here has an idea of what an asset is, but you need to update that idea into this definition I want to give to you, because it's a good reflection that you are an accountant. And the way you should define an asset is that an asset is an economic resources controlled by an entity as a result of past events. Okay, this is how you should define an asset. Economic resources controlled by an entity as a result of past events. So the first thing here is an economic resources. So what is an economic resource? You see, the conceptual framework went ahead and said that an economic resource is a right, okay, is a right to obtain or generate, potential, is a right, let me call it, that has the potential, not to generate again, you can say generate, but that has the potential to generate economic benefits. Let's put it that way. It says economic resource is a right that has the potential to generate economic benefits. So a right. So that means if you have a YouTube page, it's an economic resource to you. If you have, I mean, anything, that's why they call it a right. But it has to be your right. And that right has potential to generate economic benefits. So it's not about the past, it's about the future. If it can make money for you in the future, now and in the future, that is an economic resource. And that is what we call an asset. Anything, just think of it, anything that makes money for you is an asset. That makes money, not something you stole, or not something that the ownership is in, not even ownership, it's not about ownership, that you don't have right over. You must just have right over it. That's what we care about. Whether you borrowed it and it's making money for you, it is your asset. Now, you see, this right that you have, you must control it, which means that money is making, it must come to you. That is what we mean by you having control. The money must flow to you as a result of past events, meaning you must have acquired the assets. Not that you want to, I want to do this when I buy it, when I rent it, when I do this, I will now have money. No, the economic resource we are talking about must be as a result of past event. It must be something that you have acquired before now. Okay, so there are a lot of assets that we can have, both the one you can see and the one you cannot see. If you have a plant that you are using to manufacture an item, that's an asset. If you have a social media handle that is making so much money for you, that is an asset. If you have an invention, if you have a skill that is making money for you, that is an asset. Anything that has potential to make money for you, it is an asset. If somebody is owing you money, it is an asset. I mean, it's the list goes on and on. And we'll be learning a lot about how to treat assets in this class. The second one is liabilities. So a liability is a present obligation, a present obligation to transfer economic resource as a result of past events. Is a present obligation to transfer economic resource as a result of past events. So the key thing here is obligation. And an obligation is your duty to act in a certain manner. It's something that you have to do. In fact, the standard says that it's something that you have no practical ability to avoid. Hear my voice. You have no practical ability to avoid. That is an obligation. If you can avoid it, it's not an obligation. Meaning there's no way out for you. You have to, that's an obligation. If there's a way out that you can escape from it, that is not an obligation. No. You have no practical ability to avoid it. Now, what do you have no practical ability? What obligation? To transfer economic resource. To transfer that resources you have. So when you have such obligation, that is a liability. When you have to give when you have to give somebody something, that is a liability. When your economic resource have to leave you, that you have no choice, is a liability. It is a liability because you have to settle it. We'll learn a lot about liabilities in this class, both the one that you think is a liability and the one that you think is not a liability. The obvious one is you borrowed money from somebody. His liability is beyond that. Liability can be there is a pending court case on you. It is a liability. It is a liability for you. Or liability is where you say you sold an asset and you are still using it and you have collected money from that person. It is a liability. That money you have collected from that person, it is a liability because you might have to return it to that person. Okay, let's not overflog it for now. Equity, which is this third one, is a residual interest in the assets of an entity after deducting all its liabilities. So when we say equity, we are talking about residual interest in assets. In fact, let me leave residual alone. Let me focus on interest in the asset of an entity. You see, when you have interest in an asset, it means that whatever money that asset makes, you have a share of it. It means you have interest. And it means that you are a part owner of that asset. That's interest in an asset. So when your interest becomes residual, it simply means that you are the one that will be settled last from whatever money that asset makes. That's residual. And that's what we call equity. Is a part owner, but the money that is made from that entity, from that asset, they will settle him last. That's equity. And a typical equity is ordinary shareholders. Ordinary shareholders are owners of business, but they are usually settled last. They will usually consider the obligations first. That's why they said after deducting all its liabilities. That's equity. So generally, equity are like ordinary share capital and reserves. That's equity. Those are the residual interest in the asset of an entity. Then we have income. So income is usually defined with respect to asset and liabilities because income is generated from your assets. So we say income is when your assets increase in asset. When your assets increase, that is an income. Or could be decrease in liabilities. When your liabilities decrease, that is an income as well. I mean, your obligation decreases. That's income for us. Okay. Which will result in an increase in equity. So when your equity increase, I mentioned that equity is ordinary share capital and reserves. Okay. So if your increase in asset or decrease in liability results in an increase in equity, you see, increase in equity too can be an income. Just that increase in equity, there are two things that can increase your equity. Okay, so one of them is if ordinary share capital should increase, meaning they bring in more capital. That one is not income. Even though it is an increase in equity, it is not income. So we need to make it clear. So we say, other than those relating to contributions from owners of equity claims. Okay, so we are saying that this increase in equity is not contribution, is not additional capital. Now, this increase in equity here is like increase in your reserve. It's like profits. Increase in your profits. That's what we mean by increase in equity here. And that's increase in the profit is an income. So income is an increase in assets, decrease in liability, which results in an increase in equity, other than those relating to contributions from owners of equity claims. So later, you will learn that revenue is just a subset of income. Income is bigger than revenue. Revenue is just small. Income is increasing your assets. Revenue, gains, discount received. I mean, decrease in liabilities is huge. Income is everything, right? And finally is expense. So expense is the opposite of revenue. Expense is decrease in assets, increase in liabilities, which will result in a decrease in equity. Okay. So again, this is talking about decrease in equity. There are two decreases in your equity. Number one is losses. Number two is dividend. When you pay out dividend, it decreases your equity. So dividend is not an expense. So we need to make that clear. We now say that other than those relating to distributions to owners of equity claims. So that is saying that dividend is not expense. So this is chapter 4, element of financial statements. Chapter 4. Any questions, please? Okay, somebody raised Somebody wants to ask a question. Can you please go ahead?
Please, can you throw more light on that expenses where you write decrease in asset, increase in liability, which increase? I don't understand that, please.
Oh, okay. Okay, so expense is any decrease in assets. So whether it's your cash that is decreasing due to maybe you spend something from your money, that's a decrease in assets. So just think of your assets. If it decreases, that decrease is an expense. Decrease in assets. Or your liabilities, your obligations are increasing. That's an increase in liabilities. It's an expense. Anytime you have additional obligation, that additional obligation in reporting, we see that as a liability. Whatever it is, maybe you have to buy gas, maybe um, you have to buy some papers in the office, you have to buy internet, anytime your obligation is increasing, that's an expense. And when this happens, when your asset is decreasing, especially, and your obligation is increasing, you will see that your equity will decrease, and which means losses. Those are losses. We mean losses in this case. And that's why we quickly clarified, because decrease in equity can also mean dividend paid. When you pay dividend, you pay it from your reserves, from your retained earnings, right? So, which decreases your equity anyways. So that's why we made it clear here that other than those relating to distributions to owners of equity claims, or instead of owners, let me put holders. Since I said equity claim, holders of equity claims. Okay, I don't know, did I help? No response. Okay, let's go to chapter 5, which talks about recognition and the recognition. This will be the final. This will be where we'll stop for today. So recognition and the recognition. So this is very straightforward, because this is talking about, he's referring back to these elements, that how do you recognize them in the books? So recognition means inclusion in the financial reports, inclusion of the elements, any of these elements in the financial reports. So before you can include, so we usually have criteria for recognition. And number one criteria is that the elements must meet the definition, must meet the definition above. Meaning, if it's an asset you want to recognize, it must meet this definition. If it's liability you want to recognize, it must meet this definition. So is meeting the definition that is a criteria before you can include them in the reports. Number two, the elements that you want to include, the elements must be relevant and must be a faithful representation, meaning it must be faithfully represented. So it means that it must meet the fundamental characteristics, that element in question. So these are the criteria for recognition. So you actually need to know these two, because they can ask it in the exam. So the recognition is the opposite of recognition. It's the opposite, because it means removal from the financial statement, and it's the opposite. And when do you remove? if the item does not meet the definition again or is not relevant, it's just the opposite of recognition. But usually, we usually generalize the criteria for derecognition as where there is loss of control of an asset. As soon as you lose control of an asset, it doesn't meet that definition anymore. Or where you have settlements of obligation. When you have settled obligation, giving you a liability, you have cleared that obligation. I mean, you're done with that. You can easily remove it from the financial reports. Okay, I'm going to stop here tonight. So next on Saturday, I would finish up with chapter 6, chapter 7, chapter 8, and we are going to solve past corrections. Almost every time I finish a topic, we would solve past corrections before we move to another topic, just so that you will see the way it's asked in the exam. And that would take us around 1 hour. Yeah, it will take us 1 hour. Then next week, the remaining 1 hour, I think we have 2.5 hours. Oh, fantastic. Next week, Saturday. It's today we have 2 hours. So next, after we're done with that, we are now going to start IS 16 PPE on that same Saturday. Because based on our plan, we are supposed to finish this one today. When I was doing the plan, I know usually it's always difficult to finish conceptual framework in 2 hours because it's actually very wide and the explanations are endless, right? Except if I just want to reduce my explanation purposely and not talk about some things that I've been actually emphasizing on, which is not good for you anyway. I wouldn't do that. So yeah, we are fine. We are able to get to chapter 5, which is perfect. So we'll finish it up next week. And we're going to commence IS 16. So I'm going to stop my class here for tonight. Do we have any questions before we go?
Yes,
Okay.
I have a-
Sir.
Hi, Joy.
Okay, so my question is on this elements
Okay.
of financial statements. Now we are talking about the recognition and the recognition.
Yes.
Then the measurement of these elements, is it same with the recognition or we don't need it?
That's chapter 6. That's chapter 6, yes. We'll get there.
Okay, sir.
Yeah. All right, guys. Bye. See you.
Please remember to drop the note so we can.
Okay. I will drop the notes.
Thank you so much. Have a good night.
You
All right,
too.
thank
Bye.
you. Thank you very
Bye.
much.
Bye.
Thank you, sir.
Bye.